we have seen about the generic company statement of financial position. In the previous session, we have seen the generic company financial statement or statement of financial position. Assets, we have seen all these assets, tangible, intangible. We have seen all the current assets. We have seen the total of assets. We have seen equity and liabilities. All the assets, non-current assets, property, plant and equipment, right of use assets. This is in the case of leasehold property. Whenever you take a property on lease, you get the right of use of that asset, not the ownership. We have seen the intangible asset which do not have physical substance. We have seen investments, companies when they invest in equity instruments or they buy stocks, shares, that is also an asset. Then current assets, we have seen all this give economic benefits within 1 year. Total of assets. Then this is the share capital. This is the retained earnings. Every year the profits are transferred to this account. Then revaluation surplus, we have understood when we have an asset, an asset's value increases, and the intention is to hold the asset, not to sell. Every year we have to show the changes in the value of asset. If it increases, it's revaluation surplus. I have also given the information to you regarding one account called other comprehensive income section. And then other components of equity, if at all there are any other equity components like share premium, it would also come here. Then you have total of equity. Then all the non-current liabilities. Non-current liabilities are those which you have to settle in a longer period of time. All non-current liabilities. Then current liabilities will be taking all this total of current liabilities, non-current liabilities plus current liabilities is equal to total liabilities, and total liabilities plus equity is total of equity and liabilities. So you get this total. Just have a look to the format. Today we are going to study income statement format. Now, statement of profit or loss and other comprehensive income. So IAS 1 allows income and expense items to be presented either in a single statement of profit or loss and other comprehensive income, or in two statements, a separate profit or loss and statement of other comprehensive income. Either you can show in one statement, or you can show SOPL here and OCI a separate statement. Okay. Now we'll see the format. First, we'll start with revenue, then cost of sales. Cost of sales is nothing but opening stock plus purchases minus closing stock. This gives you cost of sales. So we can go with a small example. Revenue. You bought 100 boxes. So you bought this 100 boxes and you want to sell at the rate of 12. COGS. Opening stock is nil. Purchases. You bought 100 boxes. Cost is 10 rupees. $10. Selling price is $12. This is the cost price. $100, 100 units, boxes into 10 minus closing stock. Nil. That means whatever the boxes you have bought, okay, the purchase, whatever the purchases you have done, you are selling the whole purchase. So $1,000 is the cost of goods what you are selling. Okay, you are selling 100 boxes whose selling price is $12 per box. So since you are selling all the 100 boxes, the cost of those 100 boxes is $1,000. So the gross profit is $200. Now let's say 100 boxes you have purchased at the rate of $10 each box. You are selling only 80 boxes. 20 unsold. So now revenue. Second case. 80 into 12. 960. Plus. Minus. COGS. Opening stock. Nil. Purchases. 100 boxes at the rate of 10. We purchase 100, right? But we are not going to sell 20. So altogether, 80 boxes at the rate of 10, 800 is your cost of goods sold. So you have sold 80 boxes and the cost of those 80 boxes. See, 100, we have purchased 20 we haven't sold. So we've sold how much? 80. So since we have sold 80 boxes, the cost of 80 boxes is 800. So here what matters? How much you are selling. The cost of those many units you have to take. That's what is called as cost of goods sold. Here, the goods what we are selling is 80 boxes. So the cost of 80 boxes is 800. But you have to show everything in the format. Opening stock nil, purchases. You have purchased all the 100 boxes. Okay, at the rate of 10, that makes it 1000. Okay, 1000. Internally, I'm writing. And then 20 boxes are left over with you. You're not selling, so you can't, match the cost of these boxes with the revenue. So you have to subtract this. So 100 boxes minus 20, 80 boxes at the rate of 10, 800. That's 16. I will look through this. We'll move forward. Okay. So this is revenue less cost of sales. We get gross profit. So revenue minus cost of sales, gross profit. This is the profit which you earn from the core activity of the business. Okay. Trading or manufacturing. Then all the expenses you need to remove, operating expenses, finance expenses, all the expenses. Share of profit of associates, whatever the associate companies have to be given, and profit before tax. Associates are nothing but the companies with whom we are running a business jointly. So this is an income actually. When suppose A company is an investor in B company, and A company has more than 30% stakes in B company, let's say more than 30 but less than 50. So B will be what of A associate. So if any profits A is making in this company, let's say the profit of B company is 100 rupees and A's share is 30. So A will get 30 rupees from this. That is what they are saying here. Share of profit of associates. You get profit before tax, then income tax expense you have to subtract. Profit for the year from continuing operations. If any, let's say you are a company here whose name is A company, has two more companies, B company, C company, and this is making losses. So this company you want to sell, okay? and you have got the company's value is 100, you have sold it for sold it for 40. There's a loss of 60. So loss for the year from discontinued operations. You have to show this because you're selling this, right? You've already shown this company. You have written in the balance sheet as held for sale category. That means you want to sell this business and you are incurring a loss. The business has gone from 100 to 40 and the loss is 60. So you have to show that. Then you'll get profit for the year. After this profit for the year, as we are showing everything in the same format, we have this other comprehensive income section. All the non-realizable nature incomes come in OCI section. So here you see gains on property revaluation or revaluation surplus. It's a non-realizable nature income. Hence, we write this in this particular account called OCI. Then you get whatever the profits you've got and the gain on revaluation. You add this, you get two. Other comprehensive income for the year is this. This plus this gives you total. Okay. Have a look to this format, we'll move forward. Okay. Let's move to the next account, statement of changes in equity. So you have seen already in balance sheet. Again, I'll show you. You've seen this account, right? Equity, share capital, retained earnings, revaluation surplus, other components of equity. All this you will be having the opening balances. That means when you close the books previous year, closing balances of all this would be the opening balance this year. And this year, all adjustments you have to do to these all accounts. You can't do that in the balance sheet. So you have to make a separate account called statement of changes in equity. In that account, you have to do all the necessary changes for the current year, and then closing balances you have to show in the balance sheet. So we'll do that right now. So generic company statement of changes in equity for the year 31st December. So at the end of the year, they are making this SOC account. So you have opening balance as balance at January 2006. They're making for 2007. So previous year opening balance, previous year. So they had some share capital of 1 lakh, retained earnings of 50,000, no revaluation surplus, it seems, other components of equity, if any, like share premium, etc. So you add all this, you get total equity, opening balance. you should clearly know, let's say the company has declared or paid a dividend of 10,000. So 50 minus 10, you get 40K. So dividend comes here. Like here, let's say 1 lakh plus 50,000 is, and other components of equity, let's say extra 50. So this is 2 lakhs and 10,000 dividends we are giving here. 1.9 lakhs we have got. Now, just give me a second. Just give me a second. I'll be back. So these are the accounts you need to remember. Then you get the total comprehensive income for the year. So here 1 lakh would be the amount. So balance at 31st December 2006, 1 lakh. Retained earnings 40K. Revaluation surplus, nothing was there. So nil. Other comprehensive income, other components of equity 50K. If revaluation surplus balance you have to write. This is done. Now, changes in equity for 2007. So any changes we have to do. Issue of share capital. Let's say they issued 50,000 worth of extra share capital. Now, opening balance, the previous year's closing balance becomes this year's opening balance plus extra share capital. So 1.5 lakhs. Okay, extra share capital. Dividends they have paid again 10,000 this year. So now 40 minus 10 is how much? 30,000. Current year's profit would be transferred to retained earnings. Let's say this year the profit has been 1 lakh. So dividends of 10,000 gone from opening balance of 40. The balance is 30. And this year's current year profit. Every year current year profit would be transferred to retained earnings account, right? So 30 plus 1 lakh. 1.3 lakhs is my retained earnings balance. And this is already I had 1 lakh in the, when I, previous year closed the books, share capital was 1 lakh. This year, again, I'll start with 1 lakh only and extra shares, 50,000 if we issue, for example. So total 1.5 lakhs. Provided if we issue, otherwise it's okay. And then they have not shown anything to you like changes in accounting policy. In old books, it was there, but new books they haven't shown any such thing. So, I would also not complicate the things, but in the next session, when I'll take, that is tomorrow only, we will solve a full-fledged question. How to solve a financial statement, I'll explain you. We will solve this question, Mandolin Company. And after this, there is one more question called Wilson Company. So Mandolin Company will solve in the class. Wilson Company, I'll give you the video. You solve at home. If you're not getting, we will solve again. But we can solve one question, fresh question from the practice kit. This is coming for 20 marks, confirmed. Now, so now next one again, revaluation surplus, still nothing. No amount is there in this account. So nil. And other components of equity, we were having 50K. No changes in this year. So 1.5, 1.3. This is 2.8 and 0.5. 3.3. 3.3 lakhs is my total of equity. So now what we have to do is these balances, closing balances will be going into the balance sheet as equity 1.5 lakhs, retained earnings 1.3 lakhs, revaluation surplus as per this, no balance, other components of equity 50,000. The whole total will be 3.3 lakhs. Okay, like that. Please have a look through this. Okay. I was explaining you about changes in accounting policy that also would come in, that also you need to adjust in retained earnings. For example, if you are doing your inventory valuation and the previous method you were using FIFO method and now you want to change into weighted average. That means FIFO method you were using to find out the value of your COGS and closing inventory. That is inventory valuation, right? What's the value of this and what's the value of this? So now from this method, you want to change to this method, shift. This is called change in accounting policy. Change in accounting policy should always be given retrospective effect. What is retrospective effect? As if the change we do in such a way that the change after the change, or it is if we give a retrospective effect to anything, uh, like after policy change, it will be assumed that whatever we are going to use now is used from the beginning. That means FIFO was used since the beginning, right? Now we want to change from FIFO to weighted average. Giving retrospective application is nothing, but now we will show it in such a way that we are using weighted average since the beginning. Understood? That is called retrospective effect. So I'll write the point here. Apply the new policy. That means changing to weighted average as if it was always used in the past. Will change in such a way that it will reflect that we were using weighted average from the beginning. So what happens? Past financial statements are restated, okay, and we will do adjustments to the retained earnings account only. See, COGS will not be changed. Closing inventory value will not be changed. No change you will see in income statement. Only we will do all the adjustments in retained earnings. Okay, and how we will do? Let's see. So 2023, let's say, and 2024 profit old when I was using FIFO method. Profit new if I use weighted average method. So what happens is FIFO due to FIFO method, the expenses were less and the profits were high. Due to weighted average method, the expenses will increase, the profit has to decrease. Okay, so we will do the necessary changes in retained earnings account. What we will do? We will do the necessary changes in retained earnings account. So previous profits of 1 lakh now should be changed with 90,000. Previous profit of 1 lakh 20 should now be changed with 1 lakh 10. The overstatement of profit was the COGS was high in this, and here the COGS will decrease. Since the COGS were high, COGS what was less. Sorry. COGS was less. Hence the reason overstatement of profit. Here the COGS is high. Hence the profit has to be understated. So there is a difference of 10,000 which is getting created. Okay. So COGS here was less. So the profits were high. Here in this case, weighted average COGS is high. So the profit should be less. So what shall we do? We'll go to retained earnings account. Changes in accounting policy section will be there. The section will come in this way only. There will be one more heading here. It is not written changes in equity. You have to write again, like let's say instead of 11th, instead of 10, after 10th column, there's a 11th column called changes in accounting policy. I'll show you in old book. The format is there. So in retained earnings account, we have to deduct retained earnings account. Here is the retained earnings account. In this account, we have to deduct under changes in accounting policy section. We have to deduct something around 10K. Okay. What happened to this? So in retained earnings, let's say our balance is 10 lakhs. So here, as we are changing from FIFO to weighted average, we will subtract 10,000. Now what will happen? The adjustment is done because we need to show our profits to 90, right? Okay, not 10 lakhs. It is 1 lakh. 1 lakh minus 10,000, 90,000. Why we deducted 10,000? Because now the profits have to be shown to 90,000. Okay, because here the COGS is high and here the COGS was less. Due to less COGS, the profits were high.